Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to answer a question and a little bit about the thesis of the channel and a little bit of description of history of how these markets move, boom and bust cycles, all of those things. So this person responds with, let me zoom in here real quick for everybody so they can see it. Where are you in your real estate boom now? That is what he or she has asked. So when we look at the thesis and we look backwards, what is driving these cycles is credit expansion. Credit expansion is loans against new homes during a real estate boom. What I think this person is confused on is what is a real estate boom. It's not prices going up, it's the volume of loans against new homes. So it's the volume of new homes being built and the loans going against those new homes. So when you look at a boom and bust cycle, the boom and bust cycle is not dependent on the house prices. It's dependent on the volume of new homes being built. So that is the boom and bust cycle. So when you say what's going on, we've had some things happen that have been an anomaly in history. One of those things that is an anomaly in history is if you look at a scatter plot, and I have a scatter plot somewhere. I don't have it to yank up and show you guys at this exact moment because I'm just talking off the top of my head. The scatter plot is when the inventory levels are below 6 months. We've never had a down year. Year over year, down movement in price. We saw down movements in price in 2023 on a year-over-year basis with inventories less than 6 months, which has not happened before. It's an anomaly in history. That could be because of the interest rate increases in the amount of time that it has happened, which impacted the affordability. But if we look at the data from the U.S. housing starts, so this is the United States housing starts, the boom and bust cycles are based off of the boom, the rollover, and then the below the average. That is your boom phase. It's this entire area here. Here's another boom in real estate. This was your commodity bull market in the red there. So that was the boom of the real estate cycle in the 1970s. September 72 is where it peaked out. We came all the way back down. We had a recession here, and then we went into another one. The recession was driven by the U.S. housing starts. It was not driven by other things in the market. We had another gigantic boom. We went into a real estate boom in the mid-90s all the way up to 2005. We came all the way back down in 07 is where we broke the average and went into a recession. So this here is the volume of new homes coming into existence is your real estate boom. Went into a hyper supply phase in 2004 and 5. Built too many homes after that. And you can see the housing starts collapsed, causing a gigantic deleveraging event in the markets with bad loans going bust. We are still in a expansionary phase, but we have not built the homes to satisfy the shortages in the market of about 3 to 5 or 6 million homes, depending on what data you look at. Those homes haven't been built yet. So we are still in a housing crunch. The thing that has happened is that we went up in interest rates and mortgage rates, went up dramatically, very quickly, impacting the affordability. That also had an impact on, I think, the psychology of potential buyers. They are probably waiting for a decrease in interest rates, or eventually they're going to have larger down payments, whatever that reasoning is. They have not been able to afford homes immediately. It has slowed the markets down. But that also impacted the supply side. Potential sellers are not selling homes as much. They're holding on to their homes. And the buying and selling has been quite stable with the reduced demand and the reduced supply. It's been pretty balanced. The markets have been fluctuating up and down at the current levels that they're at. We are still in a housing market boom at this time, and we have to wait for this to actually go down to say that we are out of that housing market construction cycle boom. It does not mean that this can't go higher again either. The data has not come out yet. It usually comes out here probably in the next week or so, and we'll see which way this goes. But we are still in a housing market boom in relationship to the average, and we're still in an expansionary phase of real estate. As weird as that sounds. So I know a lot of you want to try to like make a point or say that I'm wrong, but I'm not wrong yet. We're still in that construction boom cycle, and it is not dependent on the house prices. It's dependent on the volume. So that volume of home loans also ties very closely with employment. It ties very closely because the construction cycle employs a lot of people in the economy. That money gets created. It puts a lot of things into shortages, and that has historically been the case. Could there be a case where we've got an anomaly today where we printed so much money of stimulus money that the stimulus money created so much inflation in the system that we actually yanked our real estate market down because the interest rates went high enough to the inflation rate that the stimulus money could support, not exactly being paced by the real estate market. That could very well be the case. Everything in history, we didn't have this gigantic stimulus in the system, so it was always paced by the real estate market. It was an organically driven market. This is a stimulus synthetic driven market where I think interest rates probably went too high. But that doesn't mean that the housing market is dead. What it means is that interest rates could be too high for the housing market to survive and thrive at these levels. So could we have a slowdown where interest rates come back down to a level that is more sustainable for the housing market? Yes. So the question would be, this is how you would tell if you're in a housing market boom. If you were to cut interest rates in half, would the housing market collapse? If the answer is yes, because you're in an oversupply state where you were in a housing boom, you built too many homes, and you got into a hypersupply phase, your interest rates will drop along with your house prices, and your prices won't come back because you built too many homes. It'll take time. That is where you know that you've built too many homes. Your inventories are at 12 months or 10 months or something like that. Our inventories are at 3 months. If you cut interest rates in half, home prices are going to go way up. That is how you know that you're still in a real estate boom. So when you say, where's your real estate boom now? Well, we're still in it. And you have to figure out why you think that we're not. Why do you think, put it in the comments section, that we are not in a real estate boom right now? And I'd love to hear your data. I'd love to hear your reasoning. So put it in the comments section of why you think that we are not in a real estate boom right now. And if you think that interest rates were to get cut in half, that the real estate market would not go up in price and the volume of homes would go up under that scenario. I think it would. If we're not in a real estate boom and that's changing, that means that interest rates would go down and the housing market would still suffer because we're in a hypersupply phase, and that's when we end the real estate market boom. So that's my answer there. Obviously, you guys have been going. It says going back and forth on this, but that's what I wanted to talk about. Obviously, there's a lot of things that can happen. Look at this. So here's some other things. Actually, Brandon, good responses here. The money supply has been contracted like 1929. Hilarious. So the money supply isn't what drives it. It's the real estate market that impacts the money supply. And you have to keep in mind here, though, the money supply was synthetically driven by the Federal Reserve. They created money. They bought assets. QT is going to crush that M2 money supply to some extent because they're probably destroying things when they go and sell their assets off. So there's a lot of synthetic things going on here. there's a lot of hands in the cookie jar or hands in this process that never were there before. They're messing with things. They're trying to control, they're trying to manipulate the markets with what they are doing. And what they are doing will have impacts on real estate demand and real estate supply as they are jacking around with the entire system trying to control the markets. It's not going to work. The imbalances are still there in the market from supply and demand. Now it's all about affordability. And the question is, why are rates as high as they are at? And is it organically driven or synthetic driven? That's what you have to answer. And put in the comments what your guys' opinions are on that. But that's what I've got for today, guys. I just wanted to answer that question there. You guys obviously can have a differing opinion. I'm cool with that. I have no problems with differing opinions, but I do think that the housing market boom being over has no validity to it, no data outside of house prices have gone down, therefore we are in a bubble. That's not a solid, valid argument. What you want to do is you want to understand why those prices went down and what the potential reasonings are, and then go through scenarios of saying, okay, if these inputs change, how does that change the outputs? But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And that's what I've, what my opinions are on it, at least. Love to hear you guys' opinion. Put it in the comments section, and we'll catch you next time. This is Finding Value.